Hello traders. First, let me just say that I'm pleased to hear that you found my previous video on market structure informative. However, I must mention that learning is a two-way process. While my role is to present the subject in a clear and concise manner, it is equally important for you to ask questions, share comments, and even challenge my reasoning. This will help both of us to learn from each other and improve our understanding. Therefore, I urge you not to blindly accept anything I say. Instead, feel free to question and even disagree with me. This kind of constructive dialogue will help us become better traders and analysts. Thank you for your valuable time and comments in advance. Today's subject is support and resistance. Support and resistance are two of the most crucial concepts in trading and technical analysis. Due to their vast scope of these concepts, it is impossible to cover them thoroughly in a single lesson. Therefore, this lesson will serve as an introduction to the basics of support and resistance, and in the upcoming videos I will provide practical examples and expand further on these concepts. The purpose of this video is to introduce the concepts of support and resistance, to explain the psychological pattern represented by support and resistance levels, to explain the concept of static and dynamic support and the difference between these concepts, and to provide examples of the different support and resistance kinds and their effect. The content of today's presentation is as follows. First, the definitions of support and resistance. Then I will explain the significance of support and resistance levels in trading. After that, I will go over the psychology of support and resistance level and explain what makes a support or resistance level significant. What is a support and resistance flip? And what are the static and dynamic support and resistance levels? At the end of the presentation, I will show you chart examples, but I will chart with you in a dedicated video to show you how it's done. Support and resistance definitions. The definitions I took from Murphy's book, Technical Analysis of the Financial Markets. It's a very basic TA book. I could say almost the Bible of TA. And if you haven't read it by now, I suggest you get your hands on a copy, okay? Definitions. Support. Support is a term used to describe the troughs or reaction lows on a chart. It refers to a level or area beneath the current market price where buying interest is strong enough to counteract selling pressure. As a result, when the market experiences a decline, it is halted at the support level and prices begin to rise again. Resistance. Resistance is a price level where selling pressure overcomes buying pressure, usually identified by a previous peak or high. What's the significance of support and resistance? To fully understand the trend concept, it is essential to understand support and resistance well. To keep an uptrend going, each subsequent low or support level must be higher than before. Similarly, each rally high or resistance level must be higher than the preceding one. If the dip during an uptrend goes down to the previous low, It may be an early indication that the uptrend is ending or turning into a sideways trend. If the support level is breached, there will likely be a reversal from an uptrend to a downtrend. The psychology of support and resistance. Market participants can be divided into three groups: the longs, the shorts, and the uncommitted. The longs are traders who have already bought contracts. Shorts are those who have already committed to sell. And the uncommitted are traders who either exited the market or remain undecided. Now, suppose a market starts moving higher from a support area where prices have fluctuated for some time. The longs who bought near the support are happy, but they wish they had bought more. If the market dips back to that support area, they can add more long positions. The shorts now realize they are on the wrong side of the market and hope for a dip back to their break-even point. Those who never had a position and those who liquidated long positions in the support area are mad at themselves for selling too early and hope for another chance to buy near where they sold. The undecided group now realizes prices are going up and plans to enter the market on the long side on the next good buying opportunity. All four groups are resolved to buy the dip. They all have a vested interest in the support area under the current market price. If prices decline near that support, renewed buying from all four groups will push prices up. Now let's imagine the opposite scenario, where prices start to drop instead of moving higher. In the previous example, when prices rose, market participants bought more, creating or strengthening the support. But if prices start to fall and go below the previous support level, the reaction becomes the opposite. Those who bought at the support level realize that they made a mistake. And if they are trading futures, they may even face margin calls. So they need to get rid of their positions. The shorts, on the other hand, are happy. Why? Because they shorted this level and prices started to go down, and they are becoming more confident. Now, if prices return to this level again, the longs will liquidate their position, meaning that they will become sellers. The shorts will sell more, and the undecided traders now have clarity about the market, and they will get in short as well. And this way, this level is flipped from a support level to a resistance. Okay, so now we know the significance of support and resistance levels, and we even understand the psychology behind support and resistance. But not all support and resistance levels are the same, and we need to have a way to evaluate each support and resistance level and to know if this level really is strong or not. And we evaluate support and resistance levels according to three criteria, which are price, time, and volume. What do I mean by price? Price, first question is which way is the liquidity? Because the price will most likely go where the liquidity is most abundant. How do we determine where the liquidity is at? We can do it with liquidation heat maps, with studying the open interest, order blocks, wicks, and many other ways. Time. Time is also important. The amount of time spent at a level is crucial. When an asset spends a lot of time trading at a certain level, it creates a congestion zone. These congestion zones strengthen the level, okay? Another issue related to time is recency. The more recent the activity is at a certain support or resistance level, the stronger it is. And the third part is volume. If a support level is formed on heavy volume, this would indicate that many units of this asset changed hands and would mark that that support or resistance level is more critical than if minimal trading had occurred at the level. How do we determine volume? By using volume indicators such as volume bars, a fixed range volume profile, or visible range volume profile. Okay, the next issue is a support and resistance flip, and you should pay attention because this is maybe the most important issue related to support and resistance, okay? Because let's look at the example here first. This is the Bitcoin chart, and the horizontal line is the 25K level. You can see that the 25K level was resistance. Price dipped after reaching this level. Then it was resistance. It flipped here to support, and support the third time. Okay, so how does a level flip, for example, from resistance to support or from support to resistance? The rule of thumb is that the penetration above a level or below the level has to be by penetration by a significant margin. And a significant margin is something that you cannot quantify, but I will give you a few pointers related to price, time, volume, and other confluence factors. But if we are talking about price, you could say that there is the 1 to 3% rule, meaning that if price penetrates a level by 1 to 3%, you could call it a significant margin. The reason for this rule of thumb is psychological, because the further price gets away from a level, the more market participants become convinced that this move is genuine. The second way to validate a flippening is the retest. What happens with the retest? Let's say that price gets above a resistance level. Why does it get above the resistance level? Because the buying pressure, the demand from the buyers is strong and it's pushing prices up. Now, when price gets to or above a resistance level, then the short sellers get in and they begin to sell in an effort to drive the prices back down. If the buying pressure is strong enough, the buyers will contain this selling pressure and the price will continue to rise again after dipping to a support, and this is in essence what we call a retest. Okay? Now we talked about the undecided in the previous slide. The undecided traders, when they see that the selling pressure is contained, they get in on the long side and they help the long traders push prices up. As for a time, I wanted to give you a rule of thumb. Let's say, for example, a daily close, that if price closes a daily candle above a certain level, you could assume that it's flipped. But it's not 100% correct, because you will see many times that price closes a daily candle above a resistance level or below a support level, and on the next day this level is violated to the up or to the downside. But I have what I call the one more rule. For example, if price tried to penetrate a resistance level and closed the daily candle above the resistance level and then it retreated back down again, on the second time it crosses above a resistance level, if it will close 2 daily candles above this support level, which is one more than the previous, then you can assume that the flip is genuine. As for a volume, if the breakout or the breakdown was done with heavy volume, we can assume that the move is genuine. And we also have additional confluence factors. What could serve as a confluence factor? For example, a bearish or bullish divergences, open interest, moving averages, and other indicator readings. Static and dynamic support. The difference is somewhat obvious. A static level relates to price or to time, and it is constant, it doesn't change. A dynamic level is constantly changing. However, there is a deeper meaning to it. You need to understand that price and time need to be balanced all the time. If a level is belongs to just one of the axes, to the price or to the time only, then it is not as strong as a level that includes or incorporates price and time together. And this is why, in my opinion at least, dynamic support and resistance levels are stronger than static support and resistance levels. Let's go in deeper and explain what a static support and resistance level is. Static support and resistance levels refer to specific points on the chart that are related either to the time factor or the price factor. These levels can be significant highs and lows on the price axis, as well as cyclical dates and seasonal time factors on the time axis. Symbolic numbers such as round numbers, Fibonacci numbers, and harmonic numbers can also be used as a static support and resistance level. In addition, order blocks, which are mainly related to liquidity, can also be considered a static support and resistance level due to their similarity to traditional support and resistance levels. Dynamic support and resistance. Dynamic support and resistance levels shift constantly across the price and time axes. The concept behind support and resistance is that the price always moves from a state of imbalance to balance. And as traders, we look for the imbalance to occur because this is when a significant market move is expected. When the price touches a dynamic level, price and time are in balance, and a reaction could appear that will create an imbalance. So you need to pay attention to dynamic support and resistance levels because they are important. In the last part, I will just show you some chart examples. And of course that in one of the next sessions, I will take a blank chart and I will chart it with you from the beginning to the end. I will show you how to draw these levels on your screen, and I will hold nothing back from you, I promise. Okay? This is a static support and resistance level on the time axis. Why? This is the Bitcoin Brave Liquid Coin Bitcoin index chart, and you can see that there is a pattern in Bitcoin, meaning mainly that Bitcoin is topping between November and December, okay, and it is bottoming between December and January. You can see that here on 2015 January, Bitcoin bottomed. On December 18 it also bottomed, and here the bottom was a bit earlier, it was in late November. So this is a static support and resistance level. Another obvious static support and resistance level is price, like the same in the example that I showed you before. Another static support level or resistance level is the Fibonacci numbers, because many assets obey the Fibonacci levels very well. It doesn't matter if they obey them because this is how nature intended things to be, or is it because many traders trade Fibonacci numbers. It doesn't matter. You can see that the Fibonacci levels act as support and resistance levels. Static order blocks support and resistance level. I will say again, order blocks are not related to support and resistance, but they operate in the same way. And you can see here, this is the Didex chart, I think, and you can see how a supply zone is doing its job by offering selling pressure and suppressing price, just the same as a resistance level would do. Dynamic, this is a trend line. A trend line, I think, is the most underrated thing in trading. With a trend line is a strong support and resistance level. It doesn't have to be a fancy trend line. It could be on a logarithmic chart, it could be on a regular chart, but trend lines work, and they work very well. You can see here support, support, resistance. It was support, it flipped, retested once, twice, 3 times, and on the third try we had a dump. And this is just a regular trend line that everyone can draw. But I will get in deeper on trend lines later. This is Gann angles. You can see that Gann angles also, they are dynamic levels, and you can see that they, if you draw them correctly, they are working very well. You can see these angles, how they provided support, resistance, support. Very nice. I will show you how to draw Gann angles as well. These are Fibonacci arcs. Arcs also incorporate time and price, and you can see that resistance flipped. Here it was resistance as well. Here at this level it breezed through it, no problem at all. And this is where we were currently when Bitcoin was at around 44k. You can see that it is acting as resistance very well. The most obvious dynamic support and resistance level is EMAs or moving averages. You can see here the 21-day EMA, how it is supporting the price throughout all this uptrend. Also, very simple tool that anyone can use, but it is very effective. Last one is a channel. This is the Tron chart TRX. You can see how well price obeys the support and resistance level of the channel. Okay, from support, resistance, support, resistance, support, resistance. It moves very well according to the channel. We have reached the end of this video. If you stay there with me throughout this video, let me just say thank you, and that I hope and I believe that it was worth your time. And if you sticked around with me until now, please leave a comment, leave a feedback. Let me know if it was helpful, if it was okay, if there is anything else that you wish to know. And see you in the next video. Bye.